All right, guys, another week here. We're going to go through the step 2, what's next book in the 10 step series. As we did the week prior with step 1, we went through some of the key lessons. In this one, we will go through the most important lessons in this book. It'll be the most helpful to discuss in more of a video format. So first off, we're going to skip down to the support and resistance lesson. This is one we kind of highlighted in some of the forming the game plans and chart reading lessons from last week, and we're going to give a couple of quick examples on spotting support and resistance. So we have this PRTA. Hey there, Carl. How you doing? We're just getting started here with this support and resistance lesson. And in this first example with PRTA, we can see here this green line. This was support in the name. It had broken down, and it's now acting as resistance. And we can see this bull flag or base forming down here near support. So this is one where we can see very clearly this resistance area at 50 where it hasn't been able to break. Where on the flip side, for months, the stock had supported 50. Once it breaks that, now it's starting to act as resistance. So these are things we want to be able to spot. And this is where you can help to find more defined entries in your trade. So for now, we can see for the last few weeks now, PRTA has not been able to break above 50. Every time it gets up there, it starts to reverse. So this is a simple example of trying to spot support or resistance in a name. We have another example with this MYGN. Again, another more defined bull flag that we can see. You can see very clearly 24. There's a seller there for 1, 2, 3, 4, 5 attempts now. 24 has held down as resistance. And on the support side of things, we can see for the past month or so, 22 has been supported by the stock. And you can see more recently, maybe now 22 has. So the buyers are stepping up while the sellers are staying at that 24 area. And that's where we look to buy through these bull flag breakouts. We want to buy above 24. And if we're wrong, we know that anything below 22 would mean we're wrong in the trade. And that's when we want to get out. So this is something when you're going through your watch list, like if we go through the Dow 30 like we did last week, you want to look to find those key areas of obvious support and resistance. You can even see Caterpillar here, this area of resistance in 240, and eventually the stock broke out and went for a 20-point run. And if you look at where support was, about 20 points lower, you can see that breakout being very close to the measured move of this pattern. So you can see that this was about a 20-point range in the stock. And it goes a little bit higher. It's never going to be perfect to the T, but you can get the idea of when you spot these support and resistance areas and you see these flags forming, typically the duration of that flag or the width of the flag is a good barometer of what the expected measure move can be. So if you see a 20-point flag in a name, you should expect somewhat of a 20-point breakout in time. If you see a 10-point range, expect a 10-point breakout. So this is one of the main things you want to do when you start to scan, is to find these very obvious support and resistance areas so you know when to get in the name and also most importantly when to get out. Just like this Travelers here, we can see that that's another example of support, and the stock was holding this 180 for months and months. Once it starts to break that to the downside, if you were long this name, this is when you'd want to be getting out and taking profits or taking the small loss to move on as support is now breaking. So this is one of the things you want to do when you're scanning, for this example, is to find one on your own, find very clear support, very clear resistance, draw those lines out and make them have those lines, line up as best as they can. Moving on, we're going to go on to, again, penny stocks are pretty obvious these days of why we don't invest them, but we're going to go over it very briefly. SIVBQ, which was the old SVB Bank, Silicon Valley Bank, that's basically 2 quarters away from bankruptcy. This can be a name that people might gravitate toward because they saw, a year ago, this was nearly $800 stock, and it's currently down 99.99%. And they might think there's a chance the stock is going to come back. And more often than not, if I can even zoom in to even show this trading, it's like it takes forever. Even just, people get very misled with, okay, it's at $1. I can buy it here. Worst case, it goes to 0. That's still going to be 100% loss. So even if you bought this thing 3 days ago at $1, it's now 60 cents. you're still down about 40% on that investment in 3 days, and nothing has really occurred. Where if you were to buy, we'll say Disney, for example, for it to drop 40%, it's got to be, drop down to 60, which you would have to drop down to here to have that same equivalent drop that this SIVBQ has had in 2 days on just, nothing going on. So again, lately, no one really cares about penny stocks anymore, but it's still a very relevant lesson to kind of go over when you see those cheaper names. Even for us, we try to stay anything under $20. We want to really avoid when you get into the penny stocks and below. It's just a disaster. So the most important lesson in what's next we're going to get to is going to be the 4 stages, but really quickly, we're going to briefly touch on the Save More, Thank Us Now lesson. And I'm going to use this calculator to give us a very simple reason of why we focus more on what you're going to save weekly and not what you're going to start with. So it's a very good calculator. It's a compound interest calculator where you can run simulations based off what you're currently doing. You will do this in step 2, and later on in step 10, when we do a formal financial plan, we'll use this in much more detail. But this gives you a good idea of what you're doing and where you can get to based off your current savings plan. So for the initial investment, as I said, we don't focus on what you're going to start with. We don't care. 0 monthly contributions. Put it here at 500 to simulate someone who's maxing out their Roth IRA. It's really 540 to max it out for the year, but we'll keep these numbers very simple. So $500 a month. We're going to say the average member who's joining is typically in their 30s, late 20s, early 30s. So there's about 40 years of investment time in front of them before they're going to be reaching retirement. We're going to be very conservative with the rate of return that one would earn if they're just buying the S&P or following the big picture model. So very simple, starting with nothing, saving $500 a month into, one Roth IRA, having 40 years in front of you before you reach retirement, 7% interest rate, which is an average rate of return you're going to receive buying this buy consistently. And if we calculate that, this gives you an example of what you could potentially reach in retirement. Now, with the Roth example, this is 100% tax-free. And again, it's not going to be perfect. This is not the exact dollar amount you'll reach, but it gives you a good roadmap of what you're doing and where you're going to be where you could get at. And you can see by year 40, you would have contributed about $240,000 over that period of time. And if you kept it in the market, conservatively it'd be worth about $1 million. So this is one of the key factors where it's not how much you start with. It's not how crazy of a return you need to achieve. It's just staying in the market, having simple investment approaches and sticking with it. And this kind of shows you. Now, if we up these numbers after a year being a member, you get comfortable with saving $500 a week. You're now saving, say $500 a month in the Roth, another $500 in your taxable account. You can see how these numbers can quickly really start to accelerate. And this is nothing about, trading any crazy investments. It's simply just dollar cost averaging in the market on a consistent basis. So now we're going to move on to what is probably the most important lesson in this book. And this is going to be the 4 stages. And I'm going to use the S&P for the example to draw this out. And this is something that, again, every stock, every sector, any investment you can think about is going to typically go through these 4 stages. And we want to look at this on the more broader of a time period, the more effective it's going to be. So when you look at the SPY here, again, you see a bunch of candles. It could be very confusing, when we're not that good at chart reading, but very quickly I'll start drawing out some of these stages. So we could see for all of last year, I'll draw this in red since it's a breakdown stage. We can see very clearly this broader breakdown stage. This is going to be when you're going to see lower highs and lower lows. It's a downtrending market. Last year was a technical bear market, correction territory. That's when you're going to see these breakdown stages, just a diagonal downtrend until the stock or market starts to bottom out. Now, all these stages will overlap. So you're going to start to see now as we go into the basing stage, which I will start to draw here. You're going to see that, I'll put this in orange. It's kind of like when the market or sector or stock is at like a pause. It's trading within a range. So now you'll see there's this broader breakdown and there's an overlapping base within that. And I'm going to start removing these colors to make it see similar to focus on, but you can see the market now is trading in a consolidation period or a base where it's stuck in a range. It cannot break above 420. It can't really break below 360, and it's just stuck in this range. And the range is now starting to more recently get a little bit tighter. Now it's 420 versus 380, but that's that pause where the buyers and sellers are not dictating the price action. It's a stalemate in a sense, where with the breakdown stage, the sellers were clearly in control. Now, eventually, if this pattern is to break to the upside, you're going to start to see that overlapping breakout stage as we start to see higher pivot lows forming, which we've been starting to see, and higher pivot highs, which we have yet to see as of late. But eventually in time, you'll start to see that breakout stage forming. And what we're trying to focus the most on, and what we're trying to teach you when it comes to chart reading, is being able to spot the bases or the consolidation periods within the stocks that you're looking at, and looking to get involved with them once they start to leave that base and start to enter that breakout stage. And as we talked earlier before about support and resistance, when you start to see those breakout patterns get extended to the upside and they start to flag again, but they break down lower, that's when you start to see those topping patterns. So we use that example of Travelers. The stock broke out nicely. It had this breakout stage, very aggressive up move. It starts to flag or base near highs, but instead of continuing higher, it starts to roll over. And once it starts to roll over, break support, we know our clear sign to get out. Support is broken to the downside. It's time for us to move on. So these are when you can start to spot the bases, the breakout stages, the topping patterns, and knowing when to get out. When the topping pattern breaks, you can avoid a lot of these down moves in your individual stocks. Again, when it comes to the more passive investing, if you're using something like M1, you're not going to really be going too crazy with the passive stuff. But when it comes to more the active swing trading, you want to be able to read these stages and be able to spot the bases, be able to take advantage when they leave the base and enter the breakout stage. And when you're in those names and they're in that next base or the topping pattern and they roll over, you want to be able to have those clues to be one of the first to exit versus getting stuck with it and hoping and praying that the stock or sector turns around. So this is by far the most important lesson in this book. We expand on it more in chart reading later on, and we go into more detail with all these stages. But this is by far one of the most important things that if you can take from this book and be able to read and spot these stages, will help you dramatically in your trading. So as we move on, we're going to go over again some simple game planning and some simple chart reading, and we'll go back to some of the examples. So this is actually a recent trade we put on today. Again, we were talking kind of about the base just before. You can see this base in Disney. Let me delete this line out here. So we can see this, we just mentioned before. You see the very clear breakdown stage in Disney. Again, red is for the breakdown when you do not want to be involved. It's just trending lower. It's putting lower highs, lower lows. It starts to leave that as it overlaps into the next pattern, which is going to be the base. This is where it cannot trade any lower, it's really holding up 90, this 80 area, and it's stuck within this much bigger range we can see here. And then as we zoom in and we're looking more for a short-term swing, we can see that this 100 area has been somewhat of a battleground in the name from a short-term swing trading standpoint. And then more recently, as we zoom in even further, we can see a little bull flag starting to form in the name. Let me delete these lines. We can see this little bull flag forming. And the idea is very simple. We wanted to buy above the resistance area on the short term through 100. And if we're wrong, we want to get out below the low. So it's a very simple game plan. We bought up through 100. We bought this today. If we're wrong and it's going to roll over lower, we know very clearly that below 98 is where we want to get out. We're risking $2. So for 5 to 1, that puts our target up here at 110. So if we're wrong, we'll get out down here for a 2% loss. And if we're right, and it can drift higher to 110, we'll look to take profits for 5-1 or a 10% gain. So this is a very simple game plan. Again, we saw this little bull flag forming in the name. We bought on the way up with the name. We placed our protective stop in if we're wrong, and based off that entry minus the out, we know where our target is. And then now if tomorrow the stock opens up, trades higher, is at 104, and we can justifiably raise that stop to break even, we can start to adjust where our profit taking targets are. So again, that's going to be very simple game planning. We want to remember it's entry first, stop second, target third, and you want to find the target based off the risk you're going to give that name. So in this name, in Disney, it's $2 risk at the moment. I need to aim to make at least $10 a name. I'm risking 2% and maybe to make 10%. If I'm risking 1%, I want to make 5%. And then lastly, we want to talk about taking profits, knowing when to take. So again, we talked about, of course, this is the goal to sell it up here, but we don't know if it's going to get up there perfectly. And we're going to go over an example in a trade in QSR we took recently and how we try to systematically take profits on a consistent basis. So with this QSR, again, we talked about support and resistance before. We can see that this name had some support in this 64 area. It had broken down, and we had started to see a little base forming here where we wanted to buy up off support, a support buyback setup versus the current low. So we took this trade up through 62. Our stop was 60. We were risking $2. And as the name started to break out back within its range, this was resistance up here, the 68 area. Our goal was to buy up off of support. Again, the key thing is we're not trying to buy it here. We're not trying to buy it on the way down. We're not trying to catch the low. We want the low to be put in. We want to see some trading happen within that low and then find that support buyback. We found that through that 62 area. This is when we got involved. We placed our stop below the low, so risking $2. And as this name starts to drift higher and starts to break out, this is our ideal target, is a retest of this prior high. Now, as the name starts to break out, and I'm going to let me get an arrow. Okay. So as the name starts to break out, these couple of days, we can move this up a little bit. We can move it, this day where it's trading above 62 and 63. We can raise that stop from the original 60 area up to 61, where the trade is now showing us that we are in some way right. The stock has been trading higher for a couple of days, but hasn't really done much. This was the key day when we were able to finally move this risk to break even. So the main thing is when you're in these winners, of course, this is our goal. This is the goal of the selling with retest, but we don't know these days if that is going to be the end result. But what we do know is that we were risking $2, and now that we're only risking $1, that's the one thing that we can try to control a little bit better in defining when to get out, if and when we're wrong. The upside will always take care of itself, but as long as we can manage the downside and limit as much as we can, it will keep you in, this business much longer than it would if you don't focus on that. The key part here was this day, this very bullish engulfing day. This was the time where it now made sense to raise this stop to break even. So now we got, we're $2 above our price. We're 1-to-1 on our real risk of initially in the trade, but we've now brought our risk down to 0 while holding on to what is a winning trade at the moment. It continues higher, nothing really to do just yet. We catch this gap up, and this is where, again, we're getting very close to where our target is. Our target's the 68 area. It gaps up, it trades nearly to it. This is now where we raise that stop again. And the ideal thing with how we raise our stops, we aim to raise them later in the afternoon, typically anytime after lunch. You want to get most of the day's trading, ahead of you or through the day, and you'll see this action. By the end of the day, the stock is closing looking phenomenal, but off the open, it can be very hard to anticipate what's going to go on for that day. So once we raise the stop to here, under 66, now if it wants to trade higher, that's amazing. If it doesn't, now we'll make $3 on the trade if it fails. So this is where we race the stop, and then, it couldn't get up to this, our ideal target, starts rollover, not the end of the world. We took the profits and we made, $3 on $2 risk, but we were able to continuously limit that risk as the trade progressed in our favor. And that's one of the most important things when it comes to taking profits, is having a systematic approach in the ways you can limit your risk. And that's the most important part, is finding the entry is important, defining a risk is important, but keeping the winner by raising those stops systematically will keep you in them much longer than trying to catch a top, or say it's going to, trade to here. If it doesn't go here, I'm not going to sell it. You have to be very open to what the price action is showing you. And that's what this showed us. It made sense to take profits here versus trying to be greedy and get the extra 40 or 50 cents of what the ideal target was. So that's kind of a quick little summary of this book. Again, we have a couple of funny stories in here that go over this in a little more detail that we'd highly recommend reading. We have some stories, about why we avoid earnings, but again, we went over a lot of the major topics in here. And if you, like for Cole, if you've, watched through this, you get to the end and you're able to explain, what is support, what is resistance, show an example of that, explain how you're going to systematically grow your investment accounts, how much you plan to save weekly, and what you should get to based off that plan, and explain what an A+ setup is to you. We have no problem moving up to step 3. So we hope you guys enjoyed this, and we hope we see you next week when we review book 3, step 3 in the program, which is the Dumb Money book, which we're going to go over all the policy mistakes that a lot of new traders make that we want to help you avoid by reading that book and going through this class next Monday at 5 o'clock. All right, guys. So Cole, while we're here, do you have any questions that we can help answer for you?
Not really. That was a good lesson though. I mean, I'm not typically really that new to some of this stuff, but I'm definitely taking some of this stuff that I haven't before.
Okay.
Yeah, it's definitely a lot of the basics, right? It's coming into step 1, step 2 is going to be a lot more of the basic stuff, and then as you move up into the next parts, you're going to see some more complicated things. I think that the A+ setup is a question that you need to consistently be asking yourself all the time, because you're gonna, as you get through more and more charts and more setups and take more and more trades, you'll be able to really dissect those criteria and that specific characteristics of a chart that you want to see. So over time, that A+ setup, the list of stuff is gonna extend. So
All right.
All right, guys. Well, again, Cole, thanks for stopping in, and we'll see you guys next Monday.
See ya.
Yep. See ya.